Hello and welcome. I'm Richard, and this is the Art of Arbitrage. Today on the channel we're looking at the bidding war to buy R1 RCM, the specialist provider of technology for hospitals and healthcare operators. We'll start out by looking at the background of this deal, which is more interesting than most, and then go through the numbers to see what an investor could earn from the deal today. We'll then look at what an investor who first committed to the transaction in February could be in line to make. I hope you find the content useful, and if you do, I would be awfully grateful if you would drop a like and subscribe. It would really help me with the algorithm and building the channel. So, let's get to it. R1 RCM is an American revenue management company servicing hospitals, health systems, and physician groups across the United States. R1 RCM was founded as Accretive Health in Utah in 2003, rebranding as R1 RCM in 2017. The company experienced rapid growth and in 2010 was listed on the New York Stock Exchange, with its share price increasing from $13 to a height of $30 in 2021. However, the company hasn't been without controversy. In 2014, the company was delisted from the New York Stock Exchange due to late filing of financial statements. The company subsequently submitted the required statements and filings and was able to return to a public listing. R1 RCM has also been subject to claims of unfair debt collection practices, of ransomware attacks, of a 2023 shareholder lawsuit, which the company settled for $45 million, and of claims in 2023 by Jehoshaphat Research that the company was overstating its revenue and profit. The cumulative effect of all of this bad news was a significant fall in the share price from $30 in 2021, all the way down to below $8 in 2022. In February 2024, R1 RCM was approached by a consortium of investors, led by private equity firm Mountain, with an offer to buy the company for $13.75 per share, or approximately $6 billion. However, by July, the draft proposal was withdrawn, causing the shares to drop from $14 to less than $11. Then, on the 3rd of July, Mountain returned with a solid bid for the company. The offer was reduced to $13.25 per share in cash, approximately $5.6 billion. The soap opera took another dramatic turn this week when TowerBrook Capital Partners and Clayton, Dubilier, and Rice made an offer of $14.30 per share, or approximately $8.9 billion in a cash transaction. TowerBrook already owns approximately 36% of the company and is confident of securing the deal. A special committee of independent directors for R1 RCM unanimously approved the transaction as the best path forward for the company. The deal is now contingent on shareholder and regulatory approvals. So, let's take a look at the numbers. TowerBrook is proposing an all-cash transaction of $14.30 per share. This compares to a market price of $10.90 before the takeover was announced and $13.95 at the time of these calculations. When we plug the numbers into our spreadsheet and consider the opportunity for an investor in this deal, we see a purchase price of $13.95, a forecast closing date in December, an expected downside price of $11 per share, and no dividend due nor any costs associated with a short position. This means, should an investor take a long position in R1 RCM today, they can expect an unleveraged return of 2.51%, which translates to an annual rate of return of 7.57%. And given the higher probability of this deal closing, a risk-adjusted return of 4%. If an enterprising investor were to use 50% leverage in the transaction, they could expect a return of 3.69%, or 11.14% annualized, for a risk-adjusted return of 4.2%. However, let's now consider what return would have been available to an investor should they have committed to the transaction when it was first announced in February and held onto their position. If we assume an investor took a long position in R1 RCM at the time of the announcement for $11.14 per share, and we reduce the probability of the deal closing at that time and extend the duration to close, we can see an investor would have an expected return of 28.37%, or an annualized return of 35.95%, with a risk-adjusted return of 28.44%. Should such an investor have applied 50% leverage to this position, they could have expected a return of 53.58%, or an annualized 67.9%, for a risk-adjusted return of 53.68%. We can see that a patient investor has the opportunity to generate significant returns from these situations, just so long as they don't have any heart problems along the way. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.